Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, US stocks got whacked after Yellen's comments undid any positive vibes that you might have got out of Powell and his press conference, talking about a Fed pause and acknowledging what's going on in the banking sector. And the market kind of like that. S&P pushed up to like 40, and then Yellen came out and said, "Yeah, there's no backstop for these deposits for the whole system," and the market did not like that. Europe and Asia did hold up better. Those markets not coming off quite as hard. Gold ripped higher on Powell signaling that they could be done hiking, but other commodities were a bit more muted. Nat gas is still down again, 4.5%, languishing near the lows that we saw recently. But it isn't accelerating to the downside, so it may be that it just needs to kind of make a bit of a bottom before it has a meaningful rally. But really, it's all about the weather and things like that that's going to drive whether we get a meaningful rally. In terms of vols, European stock vols down. We did see about 2 vol reset in European stuff. US was a bit more mixed. S&P lower, Nasdaq, Russell higher. Russell obviously getting whacked 3% on the sell-off. So it is definitely the regional banks driving weakness, and that filters through to the Russell and the small caps. In terms of vol in commodities, we did see a mixed picture really. Biggest moves were oil down 2 and nat gas up 2. In terms of carry, we've got pretty deep negative carry here in Europe as the implied vols reset lower, and we've had these really big moves recently. So I mean, FTSE's unbelievable, right? FTSE's realizing 31 versus implieds of 15. It's basically doubled what it's currently implying, which has been, for those who've been long FTSE gamma, you've had an amazing time. That's not to say I would necessarily buy a load of FTSE gamma here at 15, because remember that realizes backward looking, and we need to decide what we think going forward, right? And that's going to be determined by lots of other things. China carry still pretty positive at 58%. Precious metals deeply negative as gold and silver have been winging around, and energy commodities still sitting in positive carry. That's been the case for a while. In terms of skew, we saw US skew stable. Ignore this print on Nasdaq. I don't know what's going on there with the data print, but it looks clearly wrong. You've got drifting lower European skew, but these percentiles are still reasonably high. I've still got plenty of room to come down. We have seen a move in S&P skew down to 37th percentile, and that got as high as like 70, 80. So that has reset a fair amount. And it also shows that downside tail risk is being considered to be less dramatic as all these kind of actions take place. And now that we've seen Powell even say that we may be done hiking. So that's the idea there. Okay, dollar did knee-jerk lower on the FOMC. So we saw it break briefly below 102 on DXY. Has recovered a bit overnight. Stocks obviously closed heavy. Risk off tone, that generally helps the dollar. Now, looking at the charts, we're just homing in on what happened in terms of the FOMC. So, as you typically see, we had a bit of chop here, up, down, up. Market was kind of digesting the presser relatively well from what Powell was saying, talking about the idea that tightening lending standards due to the banking crisis would act like hikes. So that they would do the work of further hikes. So you wouldn't necessarily need more hikes out of the Fed. Okay, so that was being taken quite well by the market, and we pushed higher. But then when Yellen said she's not considering a broad increase in deposit insurance, look what happened to the market. Bosh. And that was driven by a big sell-off in KRE, which was the regional banks taking the brunt, because that's where all the stress is. If they do not backstop these banks, then there is going to be a problem, right? It seems like there's more stress required in the system because these policymakers need to realize the inherent fragility of a fractional reserve banking system where depositors can get an uplift in yield by moving their deposits away from regional banks into T-bills yielding 4 to 5% and improve the credit quality of that, right? Rather than taking risk of losing your money and having a shitty rate on that, you can move it into T-bills and know that that is the US government credit, and I'm getting 3 times the interest that I'm being offered by these banks. Why would I not move my money, right? And that is why money is moving faster than we've ever seen it. We're talking in the hundreds of billions leaving the door out of these banks, and this is a problem. So whilst she might not want to admit that that's where they're going to have to end up with some sort of deposit insurance across the board, there doesn't really seem to be any other solution that's going to work here, unless the Fed suddenly decide, okay, we have to take rates back down to 2%, right? Let's see how it plays out, but it looks like the short sellers are going to go after these banks again and going to force the issue like they always do when they smell blood. So don't expect this stuff to go away anytime soon. Now, what does it mean for the broad index? So we look at fixed strike vols. Obviously, you get the usual gamma models out there telling you that the street is short gamma if the market moves down, and that generally is true. It's just the extent at which you see the collapse in gamma positioning, I'm a bit skeptical. Okay, so here we've got the market at 4,000, and if the market basically dropped to 3,800, it's saying we've got a very big short gamma position here on a relative basis. Okay, I would have thought in a 1.5% drop in the market, if that is really true and we've got this steep collapse in gamma positioning, if the market falls, I would expect, even if at the money vols aren't higher, even if fixed strike at the money options, so like the 4,000 strikes aren't higher, I would have thought the downside would be like that 3,800 area should be finding a bid in vol if everyone's short down there, basically. And we're not seeing that, right? Look at all these reds. We're seeing fixed strike vol on those lower strikes across all maturities was lower. Okay, now we did have the FOMC event, so maybe it's a bit of a vol reset event pricing coming out. But the truth is, I wouldn't expect to see all of that in the red if the street was so massively short to the downside, okay, especially down to 3,800. So I suspect that these models are not quite accurate in terms of the real positioning in the market. And that makes me a bit more sanguine about the downside risk to S&P in the near term. Okay, so it's just something to be aware of. Now, obviously, if the banks keep free falling, it's going to filter through to sentiment, and it's probably going to take markets lower. But remember, there may well be a rotation, right? The more we see the banks sell off, probably the more we're going to see the rates market pricing in cuts, and probably the more we're going to see tech stocks rallying. Right. And if you look at what Apple and Microsoft have been doing recently, who's to say they don't hold up the index by themselves? Right. So I just think we need to be aware of that and not necessarily get too spooked by what we're seeing in the banks in terms of what it does and what it means for the S&P. If I was seeing more fixed strike vol bid coming into the S&P on that sell-off yesterday, then maybe I'd be a bit more nervous. Okay. But for now, that's what I'm seeing in the analysis that I'm doing, basically. All right. Now, what else are we looking at? Copper. So if we look at the big three commodities, right? Copper, gold, and oil. Since all of this banking nonsense kicked off a couple of weeks back, what's been going on? Gold's up 9%, obviously, stellar performance, as you would expect when, the integrity of the banking system is brought into question. Okay. So it's doing its job as you would expect. Oil, on the other hand, increased probability of a global credit crunch and hence recession. That hit oil. At its worst, it was down 16%. It's recovered to down 9%, but it's still not looking great. And what is copper doing? Copper is an industrial commodity. Typically, you'd expect it to be hurt by expectations of an oncoming recession. It did come off about 3%, but look at it now. It's up on that whole period, holding in really well back above that $4 level. So something's going on in copper there. And it's not like the China reopening has really delivered on promise just yet, right? So something's being priced into copper markets. They're trading quite well. And that price action for me is quite encouraging and would make me look for further upside plays in copper. So then what will we do? All right, that's it for today. Thanks a lot. I'll catch you all tomorrow. Cheers.